So here's the other deal with a priced round. And this is where I mentioned control and effective control that you can get from professional money. Although you'll almost all the priced rounds that I've seen are preferred. So there's classes of stock. Have you heard of classes of stock before, right? You usually have common and preferred. All that means is common is like this is what everyone gets that's put sweat equity in the company. Okay? Your CEO, your other co-founders, people that join the company, you give them stock options. It's all common stock. Preferred stock is what people get when they actually write you a check. And all that really means is there are preferences associated with that stock class. And so it is more valuable than common because of those preferences. Typical preferences will be things like a liquidation preference. So if you sell your company for less than the amount of capital that's invested in the company, okay, which happens frequently, right? Not everyone always makes money in the companies that they sell. Then the preferences that are associated with the preferred stock is they'll, for instance, get 2 times their money back before common shareholders get anything. So that's called a liquidation preference. And depending on what that preference is, it can be anything that you might agree to. I mean, I've seen liquidation preferences 3x and 4x liquidation preferences, which is crazy. And then there's also 1x liquidation preferences, which simply says, if my preferred shareholders wrote me a check for $10 million total, $10 million total, and I sold the company for $15 million, they get their $10 million back. Okay, so that leaves $5 million in the pool. Okay, so there's $5 million left over. Now what happens is that $5 million is split ratably amongst common and preferred. So you take the total cap table, which I'll get into cap table later. You take the total cap table and all of the shares, all the dollars get split ratably. So the preferred, they get more, right? But, to tell you the truth, they probably should get more because they actually wrote a check. They already earned their money, and they wrote you a check to get their stock. While you may have worked your ass off, right, for years to earn your common stock in your company, the fact of the matter is that's sweat equity. Sweat equity is different than cash. And you'll know that when you make your first few dollars and people start asking you to write checks. You'll understand the difference between sweat equity and actually having earned your cash, and not only that, having earned your cash and paid your taxes on it, right? And now you're going to write a check for someone. So, common preferred equity, we got that. Oh, some of the other preferences. Let me get into some of the other preferences. You can also have board seats that are associated with certain preferred stock. You will have this thing called down round dilution. Okay, so it's an anti-dilution provision. Okay, here's an anti-dilution. Is it okay? I'm going to go through all these things? Yeah, okay. You can have, so an anti-dilution provision is, I'll get rid of this. So anti-dilution. Dilution, 2 L's or 1? 2? 2 L's? I don't know. I'm horrible at spelling. So this is what happens. If I raise a preferred round, and let's say my pre-money value, so my pre for Series A, that's usually what you call your first preferred round. Sometimes if it's smaller, you can call it a Series Seed. You've heard seed financing before, right? We'll just go right into Series A. Series A, I raised my money. I got $10 million pre-money value. Now, let's say I'm 2 years down the road, and my marketplace didn't quite do what I wanted to do, okay, but I'm still kicking, and we still have some opportunity in front of us. We're going to go out and raise some more dough. And I go Series B. What if I raise that Series B, and instead I raise it at $5 million? Down round dilution if it was one of the terms of the Series A preferred stock, says that these guys get additional shares. As if when they put in their money at 10 million pre-money, it's now 5 million pre-money. So it kind of ratchets all that stuff back and says, okay, let's make, now a Series A is worth 5 million as well. That's down round dilution, an anti-dilution provision. And there's a bunch of different ways to do this. There's full ratchets, there's a weighted average, and that'll make your head swim when you start to get into all that stuff. So anti-dilution provisions is another preference that many times gets associated with preferred stocks.
Okay.
So this is where you have voting shares. Okay, when you sell your, which I erased, when you sell your common and your preferred stock, they usually have voting rights. It's usually 1 vote per share, and this is where your absolute control comes in. Okay, if you own more than 50% of the stock, and you can vote more than 50% of your shares, you make a decision on that way. Your shareholders have to decide whether or not you can sell your company. Okay? So if a particular shareholder has absolute control, they can tell you, you know what? You're only going to sell the company for 15 million. I don't think that's enough. I'm going to vote no. So if he has more than 50%, he votes no, you don't get to sell your company. That very seldom happens. And then there's, so if you've got yourself 20 investors, and the maximum that any investor holds is, let's say, 30%, then no one can really block you out. Okay? And even if you have larger investors or larger percentage stakeholders in the company, and they, you've got a potential exit in front of you, I can guarantee you every single one of those investors is in a different stage. Someone needs liquidity. Someone doesn't care because they just had a big exit, so they don't want the cash. But there's always going to be those that are going to, someone's going to vote yes because of their particular situation, and some people are going to vote no because of their particular situation. There are these things called drag-along provisions. And what that says is that if you cannot block a sale. It used to be a given one shareholder could block a sale, depending upon how the preferred stock purchase agreements were written. Okay. Nowadays, there's usually drag-along provisions. The drag-along provision says if the majority of the shareholders in your class of stock vote yes, the whole class votes yes. Okay, it can be on a per class basis, or it can be all of the shareholders.